Alright, welcome back to MMG. Let's do some TA. First of all, the markets are not open tomorrow. Tomorrow's Monday. Today is January 19th, Sunday. First of all, not financial advice. Consult your licensed financial advisor before doing anything. And I am not a licensed financial advisor. Equities, stocks, everything extremely volatile, extremely risky. Do not invest in anything you're not willing to lose or lose sleep over. Alright, so I was making some charts. But overall, I mean, it's pretty obvious this is it's a mania. The markets are just going straight up. Here's what's interesting. The dollar is strengthening right now. And it's back above the 200-day moving average, which is surprising. I wasn't sure if it was going to get back above it, but it's back above it. And that's the demand. The global economy is demanding dollars, right? Because of the outstanding amounts of debt globally, which I forgot the number, but it's ridiculous, right? So all of that debt accrues interest, and to pay just the interest, you need more cash. So the demand for dollars is high. That's what happens when the world reserve currency is it's just endlessly being manipulated and created. What it does is it creates a global manufactured bubble, right? And China is also doing it, so is Europe and Japan, and they're all doing it. But the dollar is still king as of now, and a lot of emerging markets, second and third world, even China, right? I mean, they've taken on a lot of debt in dollars, and that demand for dollars isn't going away. That's why this balancing act, right? Like a rope walker, type rope walker. Remember, like in the early 1900s or late 1800s, people used to, magicians or whatever, would walk from one building to another on a rope with a pole trying to balance. Well, that's pretty much what the Fed is doing, okay? And all central banks. But the Fed especially, because if they lean too much to the right and they print too much, maybe we'll get some inflation. But then the demand for dollars keeps rising as the debt keeps accruing globally. And they're just walking on the rope, right? And if they go too far to the right, they'll fall off, or they go too far to the left, they'll fall off. But what I mean by going to the left is, well, here's what's interesting, right? They're bailing out hedge funds and banks and everything now at this point with the repo market, and that's keeping them zombified, right? It's keeping them in business from them going full-blown bankrupt, right? Or blowing up. And that's leaning to the left, right? So they're printing, but they don't want to print too much, because if they print too much, I mean, the stock market's just going to keep going higher, and the debt's accruing anyways. Eventually, they're not going to be able to stop it from just the malinvestment and the collateral damage, right? I mean, the CLOs, right? Collateralized loan obligations. There's always, the more you tamper with the free market, you create more malinvestment somewhere else, or a bubble over here and there. And that's what I mean by it becomes such a complex system that putting out a fire over here just springs up a fire over there, and then eventually the whole thing's gonna burn down, or the house of cards will fall apart, or the Ponzi comes apart, or that's what happens when you try to centrally plan and manage economies. Same goes with people and societies, and that's what we're seeing right now. If you from bird's eye view, it's a very small group of people trying to centralize and control everything, and it's for their own benefit, right? But eventually they're going to lose control. It's like, Wizard of Oz, when they pull back the curtain, it's just this little guy, old man, pulling levers like a crazy maniac, trying to keep everything from falling apart. All right, so that's that. The 10-year yield. Remember, I'm expecting this to fall for a little bit longer because they have to keep it down. So the central bankers are going to keep pushing the yields down, because if they spike again, I don't know, the system blows up. So as long as the 10-year yield, they could keep that down, and the yields, the smaller maturing bonds, right, the 5-year, whatever, the 3-year, and then the monthlies, if they could keep them down, then the yield curve's still inverted, not inverted. It's normalized, or looks normal at least. It keeps it from inverting, right? Because if it inverts again, then even the mindless Wall Street investors will wake up to reality. Either way, as long as the 10-year keeps dropping, and I expect it to for a little bit longer, gold and silver should go up in price. Technically, the market should go up with it as well, but we also see when the market corrects, they like to really push down the yields. Well, they're gonna do it because the Fed's gonna reverse. Well, they already have reverse course. They're just gonna keep cutting towards zero, but they probably won't go below zero like Europe. Here's the financials on a weekly chart. I mean, there's not much to say, guys. Look at this. It's straight up. This huge drop right here is the 2008-9 global recession, right? So here's the S&P 500. Take away my drawings. This is a monthly chart. As you can see right here, it's just shooting straight up. It's at 33.29 right now. Pretty much 3,330 for you guys out there, for the numerologists. For the S&P 500. Let's take a look at the past few days. Yeah. This entire price action right here is essentially repo. Just want to take a quick look at the 4-hourly. This is going to lose momentum soon. Maybe a little bit higher, but I mean, if it goes straight up, everyone should notice that, right? Because Wall Street, supposedly they're professional TA experts. I mean, if it shoots straight up, everyone should be selling, and then straight drop down, right? That's what I'm assuming would happen. Here's the transports. Even the transports are going up. Not based on reality or fundamentals, because every month there's some news article about shipping freights, people losing their jobs, Another shipping company went out of business. There's less and less semis and trains uh, transporting goods because the economy is really slowing. I should look at oil. Let's look at WTI real quick. It's at 58. By the way, everyone who thinks oil is going to go up, it might, right? It should go up. It went up during the last recession, but the thing is, technically it shouldn't go up because demand for oil drops because goods and services drop, and then people are traveling less, right? Although it did go up, right? Well, it went up prior to the financial crisis. I think that was one of the reasons it might have triggered the housing bubble to pop, right? Another article just came out that oh yeah, housing starts, right? They went up 40% this past month. So housing starts are new construction of homes, and they're like pockets. It's not across the board like back in the early 2000s and late 90s in the US. It's there's just pockets of it, like in big cities, the West Coast, Washington, New York, certain areas, right? Florida, maybe, Texas, of course, and in the urban areas or right around the urban areas, right? Now, of course, there's hot Chinese money, capital flight coming out of China that's creating huge housing bubbles like in Vancouver. It's insane. Like a little shit home that's worth like 40,000 on a little plot of land in like Vancouver or yeah, in Vancouver or whatever the other cities are. Um they're going for like 1.6 million. But like 20 years ago it was worth like 40,000 or something. um but that's from hot foreign money coming in. But overall, there is a little bit of not a little bit. I mean, we're back at 2006 housing bubble levels. I just forgot to bring up that article, but you guys could look it up. Anyways, this is oil. Um, Oil's still weak. It's sitting down there, and I'm thinking it's because of the global slowdown. Not global, right? Sitting right at resistance. If it could get above 60, then we might start seeing a bull market for oil. Although the oil companies are, I wouldn't invest in those. I don't think they're sound. Listen, oil is a whole, it's a whole type of, you need it, if you're gonna trade or invest in oil companies and this and that, like that has to be your specialty. Like you have to be a professional within that commodity sector, that energy sector, right? Because there's a whole lot of shenanigans going on, and then there's government manipulations with energy. It's not easy. It's difficult. I mean, look how volatile this is. Every time the price goes up, they say the speculators push it up on the news so they could again blame the free market. But nobody talks about all the taxes, the revenue that the governments get from oil and energy, right? Because I forgot what it was. Something crazy. Like every 50 cents on the dollar, 40, it depends what state you're in. Every 50 cents, 40 cents on the dollar. So like 30 to 50% of what you pay in gas is a tax, but they tax it during the manufacturing processing part, not so you notice. Anyways. All right. So here's all the major indices. Listen, just looking at all of the oscillators for all of them, extremely overextended. MACD looks ready to roll over and cross to the downside. So we have the NASDAQ, S&P 500. This is the FANGs. This is the Dow Jones. Here's the Russell 2000 and the Vanguard Global. What do they all have in common? They've all gone straight up, parabolic, mania type price action at this point. By the way, my all-time high call, I'm off by 110 points on the S&P 500 so far, because I called it at 32.20, right? Well, now it's at 33.30, so I guess if it corrects this coming week and it doesn't go much higher, I could still say that I was close enough, right? 100 points off at this point isn't much, as it's a parabolic move up. Here's something else I noticed. The Russell 2000, right? It's the only one that hasn't made an all-time high. But it's pretty close to it. But the Russell hasn't. And that's like the elephant in the room when you look at all these indices, because the Russell is the domestic economy for the US, right? Because it's mid-size, smaller companies. I would say mid-size. The S&P is like the 500 Fortune companies, right? That's why it's 500. So, top 500 market cap and size. So, again, the Russell is the one you want to look at as a leading possible indicator for this euphoria to come to an end, because it's a bit ridiculous. Here's Apple, Alphabet, JP Morgan, Amazon, Microsoft, Berkshire. I mean, which ones are the worst? I'd say Microsoft and Apple. And right after that, JP's looking pretty crazy over here as well. Can you guys see that? Yeah, you can see that. And then Alphabet's it's breaking out, right? This month. Apple's the worst, and so is Microsoft. But I like looking at Apple because I mean, come on. Who in their right mind thinks this is sustainable? What's it gonna do? Just, where's it going? Like, you guys understand, right? As soon as you run out of buyers, this thing's gonna drop straight back down. Alright. So, let me bring up, I had some pictures, but my computer crashed because that's what it does. I can't bring it up. Anyways, this is the bubble chart, right? Here, I could draw it. Screw it. This is phase 1. Phase 2. Phase 3. Phase 4, blow off top. Then it crashes. Bull trap. And then... That's the bubble chart. That's the phases, right? It's not that hard to do. Anyone could do that. So we're in the final blow off top melt up, I believe. Could be wrong, but all I know is this is not sustainable. Not for long. Can go up another month, maybe 2, I don't know. Eventually it's gonna come to an end. And when it does, it's gonna be brutal. And I'm going to enjoy that, because a lot of that money, some of that, just a little bit of that money needs to go into gold, silver, and my mining stocks, right? And that's what happens, because markets will transfer money from the dumb to the smart. And that's free markets, competition, right? And these companies are way overvalued. This is ridiculous. This is insane. Well, who just became... Oh, yeah, Google became a $1 trillion company. A search engine. Yeah, I know they own a few more platforms, but... Alright, here's the FANG index, just straight up. This is ridiculous. What else do we have here? Oh, yeah, remember this? My gold chart to show you guys where I think we are at. So the green is S&P 500. No, it's not. Yeah, so this is gold, right? I think this is where we are compared to the last bull market. Somewhere down here, right? I did that video it was a few videos back, right? I think we're like in here somewhere. Somewhere in here. And this is what I'm expecting for the next 3 to 5 years. Of course, right now the price is over here, but so if I wanted to how do I do that thing? So here, if I wanted to, you know, markets don't repeat, but they rhyme, right? That doesn't look right. Why is it doing that? Huh. Let me try this again. What? What is it? You know, TradingView changes things all the time. Should make this candles. It is candle. Whatever. It's close enough. Doesn't look right. It's because I have too many. I have other things on this chart. That's why I can't do it. I'll do it on another one. I mean, it's very easy. Watch this. My OCD is really kicking in right now with this chart right now. Give me a second. Then we could go to a monthly. And then here we go. I think we're somewhere in here. I'm expecting something like this. If that's correct, I could be wrong, right? Could always be wrong. That's what I'm expecting. And, you know, looking at the fundamentals, like how much money's been, how much debt and fiat's been created by all central banks. Fundamentally, this might be undershooting it, right? This takes us straight up to like 2,600. But this is probably undershooting it by a lot. It's probably going to go all the way up to here. And then if it turns into a bubble, who knows? So, there you go. Kind of expecting something like this. This drop right here, that will be when margin calls start hitting and everyone's panic selling, right? All right. But it's not going to play out exactly like that. So it's the Russell. What else do I have over here? ISM manufacturing. It's hit that red line, that zero mark. If we look at the previous bear markets, If it starts heading below that, that signals a recession. And it should signal a correction in the markets, right? And we're right there again. All right, let's talk about gold. Again, some TA on it, what to expect for the short term. So right now, I mean, prices are holding up really well. Silver's at 18, a little bit above it. And gold hit, again, 1560, just last time I was trading. Here's a 6-hourly time frame. Here's the thing. I mean, the dollar is strengthening and gold's still not selling off. So what does that tell you? It's on a 7 count on the weekly, so maybe 2 more weeks of upside. And this candle right here looks real bullish. It's a nice hammer for this past week. If we go to the 3-day, still some more upside. We already had the correction from the last 9 sell on the 3-day. Although RSI is a bit overextended. So is the momentum oscillator. So it really all comes down to, are we going to get the correction finally in the equities markets like this coming week or weeks? But the fact that the price is holding up and it's not even revisiting 1500 is pretty bullish for the short term. On the daily, we could flip back up and try to retest 1600 and maybe go back above it. Here's the 12-hourly. 12-hourly is on a 6 count. I have a buy signal. It's been consolidating for past week or so. And we're about to get a MACD cross to the upside. So next week should be starting off bullish for metals. Let's go to a 4-hourly. 4-hour. I mean, it could trade in a range, right? From 1550, and then if it breaks above, if it gets above 1563, which is not hard and it's not far away, it's gonna break up and out and go and test 1600 again. To be in the clear, it really needs to get above 1575, get above this right at Kumo cloud. RSI is a bit overextended to the upside, so maybe some sideways trading for the next few days. Basically, gold and silver is just waiting for something to happen. That's how I see it. It's consolidating and waiting in the shadows here. Now, it's still going higher in all fiat currencies except the dollar. It's still hitting all-time highs. Not in all of them, but in most of them, right? Globally. So globally, it's still hitting all-time highs. Now, here's what I want to show you guys. This is extremely interesting. Well, before I show you that, let me show you the gold and silver ratio. This green square represents a bull market in gold. And the blue line is GDX, or what is that? So the orange is that, no, the blue was gold. So this orange line is the gold and silver ratio. This is the gold and silver ratio. Once it gets above, the ratio gets to like above 70, that signals a bull market. Once it gets below like 40, it's, it's going to signal another bear market, historically. Because this ratio gets really out of whack during the bear market and then gets really out of whack during the bull market. But right now, the silver to gold ratio is at 86. A lot of people say it should be like at minimum 30. But like hundreds of years, it was around 15 to 16. It all depends on manufacturing and depletion of the actual silver reserves in the Earth's crust. That's easily readable and mineable, because you have mining costs. EROI, right? Energy return on investment. So, I mean, we're still just at the beginning, infancy stage of the next bull market, just looking at the gold silver ratio. And if you really want some upside, I would have a little more exposure to silver and silver mining stocks, ETFs, you name it, right? So I just want to show you guys that real quick. So that ratio is looking great. Not just that, once silver breaks above 20 and starts running, it could lead gold even higher. Right now, gold's been leading the way. Now, here's what's really important. So we have all-time highs in gold price, right? Around 1900. The blue line, that's the orange line. That's gold price. The blue line is the GDX. Now, I don't suggest anyone should invest in GDX or GDXJ or anything. They're kind of shitty, but in my opinion. But those are ETFs of like gold mining companies, right? There's better ones out there. What I'm trying to say. Sure, they're probably gonna go up, right? With the rest of the market, but in 2016, right, gold went to 1360. GDX went to $32. And this is how all the ETFs look like. And currently, just a few weeks ago, gold went to 1615. It's a huge, huge difference in price, right? It went much higher, just the underlying value of the metal. But the ETF mining, the mining ETF only went to 32. It couldn't even break its previous high in 2016. What does that tell you? That tells you no one's buying mining stocks, despite the fact that the underlying metals are going higher. Now, this is great because it gives you more time for buying opportunity and to research some of these mining stocks. It's great for me, right, and the people in the private group, because it buys us more time to accumulate. So, what I'm trying to say is, no one in the U.S. is buying mining stocks. Like, nobody. That's because the stock market, the stock rocket, keeps going higher, and no one's worried yet. Only smart money is buying. Only certain funds, and I can see who buys these mining stocks. It's part of my research and analysis. Smart money's buying. Retail investors not buying. Most investors on Wall Street aren't even buying. So, this proves it right here. All the ETFs are not making new highs like they should be. Although the balance sheets should be, these mining companies should be able to have better earnings reports going forward from now on. And that's not even priced in yet. The past few months of the price rising so much, it's not even in their earnings just yet. This fourth quarter earnings will be the first to really look good for the mining companies, which should make their share prices appreciate, right? And fix their balance sheets and come out of debt for the smaller companies, right? So that's what I'm trying to tell you guys. The opportunity is still there. Mining stocks have not gone into like some raging bull market, not yet. Of course, if you started buying in 2015, you're sitting on some seriously awesome gains. Like, you've beaten you've beaten the stock market, right? You've done great. But the party hasn't really started just yet. That's what I'm trying to show you guys. So real quick, 944 trillion reasons why the Fed is quietly bailing out hedge funds. The fact that they're bailing out hedge funds means that long-term capital management, something really blew up in a really big way. And the system, 2008, it's like a Lehman event, right? Something like that happened, but they're trying to cover it up and they're trying to paper over it, or they're being preemptive, like they see it happening. And remember when Mnuchin freaked out at the beginning of 2019, end of 2019, or 2000 at the end of 2018, beginning of 2019, came out. He said the banks are fine, but nobody was even talking about that. What do you mean the banks are fine? um, but that's probably when they noticed something happened, and then the rates spiked on the 10-year yield, and then who knows, right? But this repo stuff is, I don't think it's gonna stop, and they're papering over something. The kiss of death when Barron's goes full bullish, right? Dow 30,000, because apparently Barron's has a really bad track record of calling the all-time highs, but not, saying that it's going to go higher, but as soon as they come out and say that, it corrects. So that's hilarious. I just want to show you guys that. So ever since 1987, it was buy the dip for the Dow Jones. And that's because of central bank policies, right? American tradition since 1987. At some point, and then here's the Nikkei, right? So Japanese stock market with their stagflation. Does this look familiar? Doesn't this look familiar? Anyone? So, Japan had a huge bubble in the 80s going into the early 90s, and then it finally popped in like 1989 or 90. And it hasn't gone back up since. I mean, this is where it's at today. Looks familiar, doesn't it? This looks like Bitcoin, right? It's the bubble chart. It's the Wall Street cheat sheet bubble chart. This is what the S&P looks like right now, guys. Just saying. It's what it looks like. Similarities, rise, right? So, yeah. What else? IMF chief warns global economy faces new Great Depression. Yeah. It's kind of like they come out right before it happens to cover their own butts. So I kind of look at it myself. So, really, the Bank of England governor fears a liquidity trap. You think? They're already in a liquidity trap. Alright, so what did I want to show you guys before I leave? So this tweet about Bernie, I think here's the thing. If the market even gets the slightest hint that Trump might not win or gets impeached, markets are going to dump for sure. But the markets are going to dump anyways. And I think the way Trump's going to play it is it's going to dump in a big way, right? 15, 20, maybe 30%. Then they're going to get it back up with the Fed and the PPT. And then on the bull trap up, no one's going to panic just yet. No one's going to say we're in a recession probably towards the end of 2020 or maybe like beginning of 2021. If he's got to time this all right in a way. And he probably wants the burn because I don't think Americans are ready for full-blown, communism. But they will in about 6 to 7, 8 years from now. Because the next recession, they will do whatever. Americans will be ready for anything. They'll be ready for full-blown lefty policies at that point because, the people in the U.S., they're not used to starving. And that's my personal opinion. And everyone's going to run for the teat, right? For the handouts. And especially the elderly, the boomers. The boomers are they're very, they're more of conservatives, but I think when things get tough and they're afraid of they're not having anything to live off of at their early age, because it's going to happen. Well, they're they're gonna just they're gonna change their minds real quick. It's the type of people they are, I believe. Um, I'm like a late millennial, but I consider myself like Gen X. I'm at a weird age. I'm definitely not like the millennials, but I'm still fairly young. Anyways, this video's been long. This was hilarious. All that cheap money, it's been going into their stocks. The best is McAfee, right? He turned out the best, in my opinion. This was a great video. Watch it in the newsroom. Very well done. This was also very interesting. It's all in the newsroom. Oh yeah. So every central bank is like getting their gold out of other central banks' vaults. They want the physical stuff before SHTF happens, right? So the Treasury brings back the 20-year bond to pay for ballooning deficits. Who's gonna buy it? I don't know. I'm not. Desperate times call for desperate measures, but it's not even desperate times yet. As markets are hitting all-time highs, and they're already coming out with 20-year bonds. Guys, it's insanity, the world we live in. If it's insane. Like I don't know. I don't have any friends on Wall Street, but I wish I did, so I could just ask him, and ask them what they think of everything without giving them my opinion, right? And at this point, it's like either Wall Street believes that the Fed can keep the plates spinning forever, or I don't know, they actually believe all this crap. They actually think everything's okay. I don't know. Zakakari, what's his name? One of the New York Fed, one of the Fed governors. He was on Twitter just trash talking gold bugs and everything. Ironically, the Fed's been buying gold, so they have to be. It's all an act. It has to be an act. I don't think they're that stupid. They are stupid in the sense of, do they actually know? Do they actually believe they can control all of this, right? I think they actually believe they are in control. And then they actually think they could save the day as well. That's how they're stupid. But they do know that they've blown bubbles. I believe, personally, this is my own opinion. I think they know what they've done, and they're okay with it. Again, guys, these central banks, they're not for your nation, right? They're like a global cabal, right? So they don't really care about the repercussions. They don't care about the plebs. All right, that's my own opinion. I'm not going into some crazy conspiracy. I'm just saying that's all it is. And all of them, they just want to serve their term, keep the plates spinning, and then get out before everything goes to hell. Just like Janet Yellen did. She got lucky, right? Janet Yellen, real lucky. Oh man, could you imagine a crisis when she was the Fed chairman? Like, just this little old lady, like mumbling, and like, everything she says was so boring. Anyways, I think I'm done. I'm boring you guys now. I'm just going on and on here. Smash some likes, leave anything in the comment section. Go to my website if you're interested in mining stocks, and the private group where I let you guys know what indicators I use. I made a little trading academy, and then I do research on some of these miners, and then you do whatever you want with that information. And then what else? I share my trades. And then it's a great community of people who also do research, just share information left and right. Could be wrong, could be right. It's just to help you out with your own research and thoughts and opinions of what's going on. All right, guys, until next time.